While you were sleeping, Shanghai opened, and this morning, something happened in the overnight silver session that every silver holder needs to understand before the New York market opens and before the opportunity that this gap is creating has fully closed. The Shanghai morning gap in silver is not a random price artifact. It is not noise. It is one of the most information-dense signals available in the global precious metals market, and it is firing right now in a way that connects directly to everything we have been building across weeks of analysis on this channel: the COMEX vault dynamics, the delivery pressures, the ratio signals, the macro environment, and the physical demand story that is reshaping the silver market from the ground up. What happened in Shanghai this morning is the next chapter in that story, and you need to read it before New York opens. Let's start with the basics of why Shanghai matters for silver, because this is the starting point that many Western investors have never fully internalized despite its critical importance to understanding silver price dynamics globally. The Shanghai Futures Exchange SHIFE is not a secondary silver market that echoes what happens in London and New York. It is an independent, significant, and increasingly dominant force in global silver price discovery that operates on its own supply and demand dynamics, its own participant base, and its own physical delivery infrastructure. China is the world's largest consumer of silver, not by a small margin, by an enormous margin that reflects China's dominant position in solar panel manufacturing, electronics production, semiconductor fabrication, and the full range of industrial applications that make silver the most industrially critical precious metal on Earth. When Chinese industrial companies, investment funds, retail investors, and state-connected entities buy or sell silver on the SHIFE, they are expressing the most direct and largest single source of physical silver demand anywhere in the world. The Shanghai morning session is therefore not a preview of what New York will do. It is an independent read on the largest pool of real silver demand on the planet, and when Shanghai opens with a gap when the price at which silver begins trading in the morning session is meaningfully different from where it closed the previous session, that gap is communicating something specific about overnight developments in that demand pool that the rest of the global market has not yet fully absorbed. This morning's Shanghai gap has specific characteristics that need to be understood precisely, because not all gaps are equal and the direction, magnitude, and context of a gap determines what it means analytically. A gap up where Shanghai opens higher than its previous close tells you that overnight developments have increased the urgency or the size of Chinese silver buying demand relative to where it stood at the previous close. Something has happened in Chinese economic data, in policy announcements from Beijing, in currency dynamics affecting the renminbi's purchasing power for dollar-denominated commodities, in domestic inflation readings that drive Chinese retail precious metals demand, or in industrial order flows that signal growing silver consumption from Chinese manufacturers that has caused Chinese market participants to be willing to pay more for silver at the open than they were at the prior session's close, that willingness to pay a higher opening price rather than waiting for silver to potentially come back to the previous close is itself a statement of demand urgency. Entities that expect silver to be available at lower prices later do not pay up at the open. Entities that believe silver will be harder to get or more expensive later because they are seeing demand signals that suggest growing competition for available supply pay the gap. This morning, the gap is telling you about the conviction level and urgency of Chinese silver demand right now. Please hit that like button and subscribe to this channel right now, because tracking these overnight global signals and explaining what they mean for silver holders before the New York Open is exactly the kind of real-time market intelligence this community is built around, and we are doing it every single week. Now let's connect this morning's Shanghai gap specifically to the physical supply picture that we have been documenting in exhaustive detail across our recent COMEX videos, because the connection is direct and the timing is critical. We have been tracking the drainage of COMEX registered silver inventories, the elevated delivery activity running above historical seasonal norms, the sluggish eligible to registered conversion flows, and the cross-market dynamics between COMEX and London that together paint a picture of genuine physical tightness developing in the global silver system. The Shanghai gap this morning adds a critical cross-specific dimension to that picture. Here is the specific dynamic to understand. When COMEX registered silver inventories are under pressure and delivery demand is elevated, arbitrageurs look globally for silver that can be sourced and transported to COMEX vaults to meet delivery requirements. One of the potential sources for that arbitrage silver is the SHIFE warehouse system in China, which holds its own registered silver available for delivery against Chinese futures contracts. But here is the critical constraint. If Shanghai is gapping up, if Chinese demand is strong enough to create an upward price gap at the open, it means Chinese silver is not cheap relative to COMEX. It means the arbitrage flow that might otherwise move silver from Shanghai to New York to relieve COMEX delivery pressure is not economically attractive or is actively flowing in the opposite direction. A Shanghai gap up into a COMEX tightness environment is therefore a double signal. It confirms that the physical supply stress is not a COMEX-specific artifact that can be relieved by importing Chinese silver, but rather reflects a genuinely global tightening of above-ground silver availability that is manifesting simultaneously on both sides of the Pacific. That simultaneous tightening is the most powerful version of the physical supply story, and it is exactly what this morning's Shanghai gap, read in context of the COMEX data we have been tracking, is suggesting. Let's talk about the currency dimension of the Shanghai gap, because it adds a layer of analysis that is invisible to investors who only look at dollar-denominated silver prices. The SHIFE silver contract is priced in Chinese renminbi, not dollars. When you observe a gap in Shanghai silver prices, you need to assess how much of that Gap reflects genuine silver demand and how much reflects currency dynamics, specifically changes in the renminbi to dollar exchange rate overnight that mechanically affect the renminbi price of a dollar-denominated commodity. This is not a trivial distinction. If the renminbi has weakened against the dollar overnight, Chinese silver prices in renminbi will rise mechanically even if the underlying dollar price of silver has not changed, because it takes more renminbi to buy the same amount of dollar-denominated silver. A gap driven primarily by currency mechanics rather than genuine silver demand is less bullish from a fundamental perspective than a gap driven by real buying conviction. Conversely, if the Shanghai gap is occurring even as the renminbi has strengthened or held stable against the dollar, meaning the gap cannot be explained by currency mechanics, it is an almost pure silver demand signal with no exchange rate distortion. This morning's gap needs to be assessed through exactly this currency lens to determine its true informational content, and when you do that assessment, when you adjust for the overnight renminbi move and look at what the gap says about genuine silver demand independent of currency dynamics, the signal becomes clearer and more precisely interpretable than the raw gap number alone. Here is something that most Western silver analysts completely miss when they look at Shanghai morning gaps: the role of Chinese domestic silver inventory levels and the Shanghai warehouse data as context for interpreting gap significance. Just as we track COMEX registered silver inventories as a measure of physical availability in the Western futures system, the Shanghai publishes warehouse inventory data for silver held in its approved storage facilities. When Shanghai silver inventories are ample, when Chinese domestic silver stocks are high relative to industrial demand, Shanghai gaps tend to be modest and mean reverting because there is abundant physical silver available to meet any surge in demand without the gap price needing to persist. But when Shanghai silver inventories are lean, when Chinese domestic stocks have been drawn down by sustained industrial demand that has outpaced the arrival of new supply, Shanghai gaps have a higher probability of being sustained and of transmitting into the London and New York sessions rather than being filled and faded. The current Shanghai inventory situation provides critical context for how seriously to take this morning's gap, and that context, when combined with the COMEX tightness we have already documented, produces a global inventory picture that makes the Shanghai gap signal significantly more meaningful than it would be in an environment of abundant global silver stocks. Let's talk about the transmission mechanism, specifically how a Shanghai morning gap flows through to London and then to New York, because understanding the sequencing and the timeline of that transmission is what allows silver holders to position intelligently in the hours between the Shanghai signal and the New York open. The global silver market operates as a continuous 24-hour trading system with three main sessions: Shanghai, then London, then New York, that overlap at their edges but are each driven primarily by their own regional participant base during their core trading hours. When Shanghai opens with a significant gap, the London market, which opens while Shanghai is in its mid-session, receives that gap as an input. London silver traders observe the Shanghai price, assess the gap's magnitude and apparent staying power, and incorporate it into their own market making and position taking. If the Shanghai gap is being sustained, if the price is holding above the previous close rather than immediately fading back, London participants begin trading at or near the gap price, effectively transmitting the Shanghai signal into the Western trading system. By the time New York opens, the question is whether the gap has been validated by London or has faded. A gap that holds through the London session that is still intact when New York opens has passed its first important test of durability. It has told you that the signal was real enough to survive contact with the most liquid and most arbitrage-efficient silver trading venue in the world, and a gap that arrives at the New York open still intact is a gap that the American market must now deal with on its own terms, either accepting the new price level by trading through it or rejecting it by selling back toward the previous close. Now let's be analytically honest about the risks embedded in the Shanghai gap signal, because intellectual integrity demands acknowledging both what the gap suggests and what could make that suggestion wrong. The primary risk to the bullish interpretation of this morning's gap is that it represents a temporary liquidity-driven distortion, rather than a genuine demand signal. The overnight Shanghai session, particularly in its opening minutes before full liquidity develops, can see exaggerated price moves driven by thin order books rather than deep, sustained demand, a gap that opens on thin volume where the first trades of the session gap higher but then immediately attract sellers who bring the price back toward the previous close as liquidity builds is a false signal, a technical artifact of the session open mechanics rather than a statement about silver demand. Assessing the volume and the price behavior in the first 30 to 60 minutes after the Shanghai gap open is therefore critical for determining whether the signal is genuine. A gap that holds on expanding volume where the price stays above the prior close even as more participants enter the market and add liquidity is a validated gap. A gap that immediately fades on the arrival of normal session volume is a noise event that should not drive positioning decisions for Western market participants. The second risk worth acknowledging is the possibility that the gap reflects a factor specific to the Chinese market that does not have direct implications for global silver supply and demand. Chinese domestic policy announcements, regulatory changes affecting specific Chinese industries, or idiosyncratic domestic financial conditions can all create silver price moves on the Shanghai that are primarily China-specific rather than reflecting global physical silver dynamics. If this morning's gap is driven by, for example, a Chinese government stimulus announcement that specifically benefits solar panel manufacturers, an industry that consumes enormous amounts of silver, The implications for global silver demand are real and lasting, but if the gap is driven by a regulatory change affecting Chinese commodity trading margins or by a domestic financial liquidity event that moves money temporarily into silver futures as a parking place, the implications for the global silver market are much more limited. Assessing the overnight Chinese news flow, understanding what specifically happened in China between yesterday's close and this morning's open is essential for correctly interpreting the gap's source and therefore its global significance. Let me now talk about what silver holders, specifically as distinct from silver traders, should do with the information that this morning's Shanghai gap is providing. The distinction between holders and traders is important because the actionable implication of the gap signal differs significantly depending on your time horizon and your objective. For silver traders, investors with short time horizons who are trying to capture near-term price moves, the Shanghai gap creates a specific near-term setup. If the gap is validated by the London session and arrives at the New York Open still intact, the near-term bias for the New York session is positive, with the gap level serving as a technical reference point. A New York Open that trades above the gap level with conviction suggests the move has further to run in the session. A New York Open that fills the gap trading back down to the prior Shanghai close suggests the signal has been rejected and the near-term bias has shifted for silver. Holders, investors with medium to long time horizons who are holding silver for the structural reasons we have built across multiple videos on this channel, the Shanghai gap is not primarily a trading signal. It is a confirmation event. It is the global physical market speaking in real time about the demand pressure that is building in the largest single silver consuming economy on Earth, expressed through the most direct possible mechanism, a higher opening price that reflects willingness to pay more for silver right now than yesterday. For long-term holders, that confirmation strengthens conviction rather than creating a near-term trading decision. It tells you the thesis is visible in real market behavior, not just in analytical frameworks. That is exactly the kind of validation that makes holding through short-term volatility psychologically manageable and analytically justifiable. The Shanghai gap this morning is therefore not just a price number to note and move past. It is a window into the real-time behavior of the world's largest silver demand base, arriving at a moment when the global physical supply system is already under measurable stress from the COMEX dynamics we have been tracking, when the macro environment is aligned with the structural silver thesis across multiple independent indicators, when the gold-silver ratio continues to signal undervaluation, and when the full weight of the industrial demand revolution from solar, EVs, and semiconductors is just beginning to be absorbed into market pricing. Every one of those factors was already in place before Shanghai opened this morning. The gap added to them a real-time, market-generated confirmation from the most important physical demand market in the world. Taken together, the picture these signals are painting of where silver goes from here is one of the most coherent and most comprehensively supported forward-looking cases in the silver market's recent history. Leave a comment right now and tell us, were you tracking the Shanghai overnight session when this morning's gap opened, or is monitoring Asian silver market activity something you are adding to your analytical framework after watching this video? The evolution of this community's market monitoring sophistication is something we track closely, and your comments help us understand where to focus the next level of detail. And if you know a silver holder who is making decisions based only on what they see in the New York session, someone who has never looked at the Shanghai gap data or understood its implications for the global silver market, share this video with them right now, because the silver market does not stop when New York closes. The most important signals sometimes arrive while you are sleeping, and the investors who wake up knowing how to read them are the investors who are already positioned. When the rest of the market catches up, we will see you in the next one.